Welcome to Tip TV Finance, where I'm joined by Ian Williams, who is Chairman and CEO at Charteris. How are you today, Ian?
Okay, fine, thank you.
All right, we're in a difficult time as far as the market's concerned. Some people think it's too good to be true, and some people think that it's buy. Not easy time to be a fund manager, I would assume.
Well, it's not that bad. I mean, FTSE's at an all-time high. I mean, it's a lot better than if it was an all-time low.
Okay,
so.
all right. Well, let's go to the presentation proper then. You brought in some slides today.
Okay.
Gold, your gold fund is your sort of star vehicle. Let's say you're known for that. And what is this chart telling us?
Well, basically, it's people are now looking at, is the era of deflation ending, and is it going to be replaced by a period of inflation or reflation,
Yes.
or stagflation maybe, but something with inflation in it.
Yeah.
And people are now turning attention away from monetary assets like gilts into physical assets like property and precious metals. And the reason our fund did so much better than the other gold funds last year is it's actually primarily a silver fund. It's got 70% of its assets exposed to silver mining companies as opposed to gold mining, and silver has double the volatility of gold. So what we say to investors, if you want exposure to precious metals for whatever reason, but mainly because you think they're going to go up, silver will go up a lot more than gold. So it makes sense to own silver over gold in a bull market. If you're not sure about that and you don't like precious metals, well, then you don't buy either silver or gold. So.
Right. So, but I mean, apart from a minor time there. Well, actually, no. I mean, this is basically been that silver has been in charge most of the time.
Yeah, I mean, silver's more volatile up and it's more volatile down. So if you think we're going into an upswing for precious metals, or you want sort of 3, 4, 5% of your overall portfolio exposed to this sector because it is inversely correlated to other sectors of the market, so you want it for portfolio balance as well, it makes sense to own silver over gold, because silver will do better if the reasons you assume that the reason you want to buy them in the first place, if that comes to fruition, you'll make a lot more money in silver than you will in gold. That's why our fund outperformed the sort of other ones in the sector last year by about 70%. I mean, the differences are huge. It's not like, well, you get an extra 5 or 10%.
Obviously, you're keeping this quiet, this secret, because you don't want your fellow fund managers to find out this easy hack in terms of out delivering on performance.
Well, there's only 7 or 8 gold and precious metal funds in the sector, and everyone knows everybody else, and everyone knows why our fund went up. But it's not as easy as just flicking a switch, because the bigger funds in the sector are locked into things like South Africa, where they hold big chunks of
the gold, maybe they're gold biased, or they're more heavily weighted in that area.
Yeah, they're locked in, and in order for us to have such a high weighting in silver, we had to change the name of the fund, get it re-registered with a regulator. It was a lot of hassle. I mean, you can't just flick a switch and say, right, I'm going to sell all my gold shares and buy a load of silver ones, because there's constraints on the amount. Our competitors have got constraints that we used to have on the amount of silver we can have, because they're called gold funds. So we had to jump through all the hoops to change it from gold fund to gold and precious metals fund. So we can now have as much silver as we want, or platinum or palladium. So.
Excellent. Let's go on to the next slide, which is an eye-opener, to say the least.
Okay. Well, my original background, which I spent many years at, was the institutional gilt market. So I spent many years specialising in gilts, and also primarily index-linked gilts as well. And what that is, that's the entire yield history of the gilt market ever since the first gilt was issued in 1703 to finance the Napoleonic Wars. And what it shows is that we've had the biggest bull market in gilts in history. The yields are now down to the lowest level in history, lower than even at the Great Depression in the 1930s, when, however bad things might seem at the moment, they're not as bad as they were then. And the bull market's gone on for just over 40 years. So the 40-year cycle, we think, is complete. The bull market in gilts is over. That line falling is yields, which is inverse to the price. So that the yields coming down, price going up. prices are virtually at an all-time high, or were until quite recently, and we think the party's over for bonds. We think bonds are now, as the deflation trade ends and people move away from monetary assets into physical assets, the party's over for bonds, all bonds, not just gilts, because corporate bonds are priced off gilts. And gilts and bonds are now in a multi-year bear market, as far as we can see.
So and this could turn sharply, or is it going to be a slow turnaround? Is it oil tanker? Is it hockey stick? What do you reckon?
The best guide is, because I think the Bank of England is probably 6-9 months behind the Federal Reserve. So if you want a sort of best guide to what might happen in the UK, just look at what's happened in the US over the last year or so. The Federal Reserve has decided to normalise interest rates. They've decided with over 2% inflation, potentially over 2% growth, which is potentially what you got in the UK as well. 25 or 50 basis points interest rates is completely inappropriate. So Janet Yellen has started to normalise interest rates, and as the process of normalising interest rates, and what she means by normal, if you go back to the long-term historical norms, that probably equates to a federal funds rate of 3 or 4% would be the historic, average level. So if norm means, say, 3, and they start off at 0.5%, gradually they want to get interest rates up. If you look at the reaction in the Treasury market to when the Fed started raising rates, over the last year, the 30-year Treasury lost about 25% of its value. And they've only moved rates up to 0.75. They've only gone up by 50 basis points. They're supposed to be doing...
A bit of a hockey stick situation.
Yeah. So the bond market's already discounting a federal fund in the United States of probably 1.5% already. It's already moved there. But if it got to 1.5% and then started to move up to 2 or 3, you'd see another big sell-off in the Treasury market. Now, you haven't really seen that yet in the gilt market, because the Bank of England hasn't yet started the process of putting rates up. But because post-Brexit, sterling came down, a lot of economists start revising up their growth on the basis of a lower sterling, revising up their inflation forecast on the basis of a lower sterling. So both are now probably over 2%. We've still got interest rates at 0.5%. They're going up. They're not going down any time. And also Draghi last week signalled the end of deflation. So it looks like all this uber easing in the Eurozone is coming to an end, and they will eventually get round to doing the same thing, and they'll be putting rates up. So rates worldwide are on a rising trend in sequence, and the next one to probably fall into line is probably going to be the UK. So it's quite a bearish scenario for UK gilts.
Okay, we're just about out of time, but just a quick glance at this last chart here.
Well, again, just shows you, I mean, in tune with the other chart, that gilts are a 300-year high. What it's done, it's pushed the yield ratio between gilts and equities, again, to very close to record levels. So equities are effectively the cheapest they've ever been relative to gilts. And that doesn't mean equities are cheap in absolute terms. If you start looking at P ratios, people start thinking, well, Whitbread on 25 times earnings or something doesn't look, or 2% yield doesn't look overly cheap to me. But if you look at an average equities and relative to gilts, equities look cheap. Now, you could spin it around the other way. Say, well, it's not really equities that are cheap, it's that gilts are grotesquely overvalued, which is probably a more accurate way of describing it. But it's still the same. If you're going to switch from one to the other, it probably makes sense to be in equities rather than gilts to the maximum amount you can, especially going back, if we're going from deflation to reflation, gilts are a monetary asset that benefit from deflation. If deflation's coming to an end, it's another box to tick that the bull market in gilts is over, and you want to be in reflation-proof assets rather than deflation-proof assets.
We shall see what happens. Ian Williams, Chartered Wealth Manager and Chairman CEO at Charteris, thank you very much for coming in today.
Lovely. Nice.